Hello guys, welcome back to my YouTube channel, and in this video, I'm going to deep dive specifically into an area within the CCR where I see the next wave of opportunity. And I will dissect what are the kind of attributes a condo have, be it freehold or leasehold, mega or boutique development that drives the profitability of a condo. But first, let's quickly recap on what we've explored previously. And in the first part of this video, I've started by acknowledging that there is a herd mentality out there now because there is this preconceived notion of what is the right kind of property. And this herd mentality has caused a very tight supply amongst the more popular resale condos. And I challenge you to think beyond that herd mentality because buying pattern is not homogeneous and not all buyers out there want the same thing, obviously, right? Not everyone wants the three-bedder near MRT, near good school, or near HDBs with strong proof of upgraded demand. Next, we explain how this scarcity has pushed the prices up and opened up opportunities for savvy investors willing to explore overlooked areas. And more importantly, we discuss how property layouts are evolving thanks to the new URA guidelines and how the recent land bid prices are favoring the CCR properties. And these two factors give me pretty strong conviction that the market is starting to shift towards the CCR. It is definitely a lot to digest, but the key takeaway is don't just follow the crowd. So if you are ready to explore these opportunities with a fresh perspective, be sure to continue watching. But before I begin, I would really appreciate if you could do me a small favor by liking and subscribing to this video, and better yet, share to people whom you think can benefit. Thank you in advance. So you might ask me which area in the CCR is a good buy. So let me try to draw parallels from past profitable condos first. Let me just give two examples. The first one is Seaside Residences. Let's take a look at how much was transacted at launch and compare the prices to the surrounding resale condos within 1 kilometer to Seaside Residences at that point in time. So Seaside Residences launched in April 2017, so I filtered for transaction data between Jan 2016 to June 2017 to have enough meaningful data. So overall, Seaside Residences transacted from 1421 to 2012 PSF at launch. But let's take a look at the transacted prices of the surrounding resale condos within the same time frame. Mandarin Gardens from 733 PSF to 1066 PSF. Neptune Court highest at 800 plus PSF. Villa Marina 993 PSF highest. Laguna Park, Fernwood Towers, Lagoon View, all maximum around 1000 plus PSF plus minus. So the lowest PSF at Seaside Residences is already easily 40% higher than the highest PSF in the area. And second example here is Jadescape. Very similarly, I compared it to the resale condos within 1 kilometer to Jadescape. Jadescape launched in Sep 2018, and I filtered for transaction from Jan 17 to December 2018. Jadescape transacted from 1448 PSF to 1835 PSF at launch. And the surrounding resale projects mainly transacted to a maximum of around 1200 plus PSF during that period. So what does these two data points tell us? So back in 2017 and 2018, many actually hesitated to purchase developments like your Seaside Residences or Jadescape due to the very large PSF gap and the sheer number of units. So the natural question everyone was asking is, the price gap to the surrounding resale so much, who am I going to exit to next time? And mega development with so many units, too risky already. And remember, this batch of condos launched in 2017 to the 2018 era. And if you recall before that, from 2013 all the way to 2018, it was actually the lull of the property market. Let me try to pull out the property price index, the PPI. And this PPI actually tracks the movement of our private property price. And you can see that it's actually sloping downwards. Essentially, at that point in time, when you were buying in 2017 to 2018, right, there's actually no good data point to back up one. Not like now, many good new launches, and we can back it up with very, very good resale data. And those who managed to overcome all these obstacles and understood what was happening in the market at that point in time went in and made very, very good profits today. And today in the CCR, specifically in the River Valley area, we are already beginning to witness a positive shift in sentiment. While there is some similarity that we can see here, we are not quite like the early stages of Seaside Residences and Jadescape when they first hit the market. Because remember, I mentioned buyers of these two projects didn't have the benefit of good data to give them the confidence to enter the market. And for the River Valley area, we are starting to see the first batch of TOP units reaping good profits. Case in point, like your Avenir and Irwell Hill Residences and a few others. So just take a look at the profitability of Avenir, just TOP, 14 profitable transactions, 0 unprofitable transactions. And filtering for the profits for the 3 and 4 bedder, ranges from 369K all the way to 1 million. Pretty good profits lah. And for Irwell Hill Residences, just TOP not too long ago, 10 profitable, 0 unprofitable transactions. Only 1 and 2 bedders sold so far, ranging from 70K all the way to 268K profits. Not too bad. And remember, these buyers bought in when people were very fearful of the CCR. Now the good data are slowly coming in, and of course, I reiterate again, not quite early like the Seaside Residences and Jadescape kind of era, but we are still relatively early today. Once more good data points start to come in, this will generate more eyes, more attention into the area, and which will then drive prices upwards. This is like a cycle lah. Now let's try to look at a few older resale condos in the River Valley area to try to dissect what are the kind of attributes a condo need to possess in order to be profitable. And I filtered for condos within 500 meters from Great Wall and Havelock MRT stations, basically the condos in the River Valley area lah. You have the newest condo here, Martin Modern, hitting 2.9K PSF, a slightly older freehold condo, 8 St. Thomas at almost 3.3K PSF, and Rivergate, a freehold one at 3K PSF. And then we have elsewhere, Ori at Toa Payoh coming in at around 2,800 PSF on average. Alta at Clementi at around 2.5 to 2.6 PSF. Parktown at Tampines around 2,300 PSF on average. And notice all these PSF are new benchmark PSFs, meaning prices that we have never seen before in their respective areas. And the first takeaway here is that over here in the River Valley area, we are seeing record prices that have already been set before. And today, the market has yet to hit back that price or just, barely touching the previous high. So as a buyer, you will fall into any of these two categories. So are you aiming to invest in areas that are consistently performing well and setting new benchmark price? Case in point, your Ori at Toa Payoh, Alta at Clementi, your Parktown at Tampines. Or are you more comfortable targeting regions that previously already set the record PSF and are now starting to climb back up? Next, we try to answer if 99 or freehold is better, and does the size of the development matter? The biggest one we have is Valley Park, 728 units, followed by Rivergate, 545 units, followed by Martin Modern, Martin Place, Admiral Park, 8 St. Thomas, and Horizon Towers, a mix of 99-year and freehold condos. And some smaller condos. Obviously, I didn't go for those, apartments below 50 units because we really don't have enough transactions to have meaningful discussions. And for the smaller ones, we have Luma up at Robertson Quay and Harvest Mansions, also a mix of leasehold and freehold ones. So we sort them based on the annualized capital gains to see which condo outperforms the rest. Not surprising, Rivergate topped the list, our typical freehold large development, which a lot of people like. Then followed by Martin Modern at second place, surprisingly a 99-year leasehold development, despite having a much higher average PSF than the rest. Martin Modern still performed well, highlighting that even 99-year leasehold condo that is predominantly dominated by freehold counterparts can yield significant returns. So Martin Modern is about 600 PSF more than the third placing, your Valley Park, and more than 1K PSF more than Horizon Towers. So from this table, what does this tell me? Does 99 or freehold matter? Honestly, not so much. We see Martin Modern outperforming the freehold counterparts. We also see Horizon Towers, a very old 99-year, I think now almost a 50-year-old development already, performing pretty well with annualized gains of 3.1%, tying with Valley Park, which is a 999-year condo at third placing. Then we have the other end of the spectrum, those that did not do so well. 8 St. Thomas, surprisingly a freehold condo with decent size 250 units, but have a loss of 0.7%. Up at Robertson Quay, 99-year leasehold, lost 1.3% annualized. Then the worst of all, Luma, a freehold boutique project with an annualized loss of 2.6%. So obviously the most profitable ones are, not surprising, Rivergate, a large freehold in the area. They obviously will make the most money, right? But it is the second and third placings that I really want to dive deeper into, which is Martin Modern and Horizon Towers, both 99-year condo. I will also touch on up at Robertson and Luma, the other end of the spectrum, the poor performing ones, to try to dissect why condos like that just don't make money. So if you are looking at developments in this area, see if you can find some commonalities for your own purchase. So let's first dive into Martin Modern. For instance, if you want to buy a 3-bedder here, it will set you back at around $2.7 to $2.8 million for the 3 compact, and all the way to around $3.6 million for the 3 premium 1421 square feet. And compare this to what you can get for the top performing freehold counterparts, Rivergate 3-bedder, minimally already $4.1 million. Then Valley Park 999-year, but TOP in 1997, a super old condo. The 3-bedder transacted from 3.2 all the way to 4 million. And remember, such an old condo, most of the time you need to fork out a lot of cash upfront. Cash upfront means unleveraged to do gut reno. So what is this gap that Martin Modern has that allowed it to outperform the competition, even those larger freehold ones? Basically, it is a quantum game, and they are offering a product that people cannot find in the River Valley area. Say if you have a limited budget and you die need a 3-bedder in this area, Martin Modern is probably your only choice. So Martin Modern has, kind of positioned itself to offer a 3-bedroom unit at the $3+ million mark. And this, you don't have to spend more money for reno because it is a relatively new condo. So all this makes it a very compelling choice for buyers on a budget. Of course, the unit size is smaller compared to the older resale condo, but it doesn't compromise on the functionality. The 3 main bedrooms are still there. That said, apart from the price, Martin Modern also has very efficient layouts. Really nothing to complain here. For example, the 1399 square feet 3-bedder layout. No wasteful spaces like your bay windows and planter boxes, unlike the older condos. Over here, the moment you step out from the private lift, it is a nice balcony with good view. Dumbbell layout which saves a lot of space. And each bedrooms are good size. Nice landscape living area, the standard, all available as well, like your enclosed kitchen, store, WC behind. So apart from the good layout and price, Martin Modern also has that wow factor, that sort of, emotional appeal to buyers. And especially when it comes to the resale market, it is not always about numbers. It is about selling emotions. People who are buying for own stay would much rather buy a nicer and newer product, even though it is a 99-year, because they are buying for own stay and they focus on staying and enjoying the place rather than focusing on whether the property is a 99 or freehold tenure. And if you have been to Martin Modern, if you look at the facade, it is a much nicer project than the ones in the area. The whole vibe of the project, the moment you drive in, really nothing much to complain. Next, we have Horizon Towers. Very interesting here. Conventional wisdom will tell you to avoid old leasehold condo. It is a 99-year condo from 1979, meaning 46 years old already this year. Look, right now everyone is singing the same tune. We all have been conditioned to think that buying old leasehold is very dangerous, got lease decay. Buy already confirm lose money. This is also not considered a big development with only 200 plus units. Double whammy but outperforming the rest in terms of capital appreciation. Let's try to find out why. The first thing you'll note is that Horizon Towers only has 4 and 5 bedroom types, which caters to owner-occupiers. Don't have the 1 and 2-bedder that attract investors, which I would like to call low ballers. Because if the price or the rental yield is not right, they just move on. No hard feelings one. So Horizon Towers have the attribute that attract owner-occupiers who are generally a bit more desperate to secure a place and they are willing to pay premium prices. Second, if you look at the transacted prices, the 4 and 5-bedder transacted from 3.1 million to a maximum of 3.7 million. Honestly, pretty decent price for a good location. Remember, I just shared that Rivergate 3-bedder already minimally 4.1 million already. See the price gap now. Third, check out the floor plan, 2,000 plus square footage of good space. You have 4 bedrooms and notice how each bedroom comes with its own toilet. The master bedroom a bit irregular here, but it is big enough to put king bed, dresser, and even a huge wardrobe. The living and dining space is huge. You have a store, WC behind, and a good sized yard area. Basically, don't have unnecessary planter and bay windows all around it. Again, notice the gap that Horizon Towers is trying to fill. Granted that it is an old leasehold development with not a lot of units, so just by analyzing it from the macro level, we are all conditioned to think that Horizon Towers confirm fail. So the takeaway here is that are you buying the unit with special attributes? Attributes that will continue to garner demand even if the property is very old. So does it fit any gap in terms of supply in the area, be it layout efficiency or the price gap? Next, we have the underperforming ones. In fact, the lost performing ones. We have Up at Robertson, not a very big project with only 70 units. Only 1 and 2 bedders, which again, mainly attract investors. Let's check out the biggest unit we have here. 2-bedder at 1368 square feet. Very amazing. 2 levels. Top floor got nothing. Totally wasted. First floor with a very large wasted PES space. The common bedroom, very interesting. Can open up fully with bifold door, so your living area will seem bigger. But unfortunately, can only fit in a single bed here because it is flanked by wardrobes on both sides. This layout is asking 2.39 million on Property Guru, and even the smaller 2-bedder 1119 square feet also asking 2.35 million. Pretty high price due to the overly large wasted space. And lastly, for Luma, very similar narrative here. Boutique 75 unit development only have 1 and 2-bedder. Let's look at the biggest unit available, 2-bedder at 1173 square feet. This layout slightly better than the one up at Robertson. Two very good sized bedrooms. Even comes with a bomb shelter. But honestly, the planter and bay window practically runs through the entire unit. Wasted, if not would have been quite a good layout. And the transacted price for the 2-bedder also in excess of $2 million already. So from these 4 examples I just gave, I hope you get some takeaways on what are the attributes a condo should possess. Generally avoid small projects and developments with a large percentage of smaller unit types. And it doesn't really matter leasehold or freehold. And I just want to quickly summarize that it is especially important to understand the market dynamics and recognize opportunities at the same time. Just as savvy investors capitalize on uncertainties of the past market cycles during the Seaside Residences and Jadescape era, buyers today can benefit from the emerging trends in the CCR era. And with the increase in the RCR and OCR prices, but with the relatively stagnant growth of the CCR, we got to sort of start to look elsewhere for the next pockets of opportunity. And staying attuned to this shift will not only help you navigate potential risks, but also seize opportunities in your property investments. Anyway, that's the end of this video. If you are looking to buy a property and this systemic data-driven approach resonates with you, do reach out so we can work something together. Do remember to like, share, and subscribe. See you in the next video. Bye bye.